So quick recap of the property market. I wanted to get that inflation and OCR kind of spiel out of the way right up front because that's what's on everyone's minds. But in the property market itself, no surprises here. The data's remained pretty weak. So sales activity actually strikingly low this year. It's been a really weak year. It's looking on track that we'll have about 65,000 property sales this year for the calendar year. That'll be the lowest since 2011. So you've got to go back a long way to find sales as low as what they've been lately. In fact, if they do come in about 65,000 for the year, that would be the third lowest. So it's the lowest since 2011, but over the last 30 years, it would also be about the third lowest total. So pretty much we're looking at sales at multi-decade lows, which you can see on the left-hand chart here. This is monthly as opposed to calendar year, but you can see the sharp tailing off on the right-hand side of this chart. Monthly sales volume is really low, and you can sort of trace through, cut through the volatility in there. You can sort of look back to that 2010, 2011. That's the last time we had sales this low. So it's been a strikingly weak year for activity. I mean, buyers aren't in any rush, sellers aren't in any rush. You, as a seller, you're still in a job. You don't necessarily have to sell. You can sit on the market. You can take it off the market. So yeah, everybody's sort of gone into this quiet phase, and that means that sales aren't happening as much. Around the country on the right-hand side, this is sales over the last 3 months compared to the long-term average for those 3 months in each part of the country. So you can see New Zealand there down about 27% on where it normally is for this time of year. Auckland's down 38%. So Auckland sales pretty weak, but it's not just sort of an Auckland thing. It's right across the country. As you can see, those main centres all pretty weak. Christchurch and Dunedin perhaps a little bit less weak, but still down pretty significantly, 15 and 20% compared to the norm. So sales really quiet. That, as typically happens, is translating into weaker property values as well. So on our house price index, we've now seen a fall of 8% from the peak in terms of national average property values. So it's getting up there. The worst point of the GFC, or the ultimate peak to trough decline in the GFC was 10%. So we're getting pretty close to that, and hard to see momentum slowing down anytime soon. So we are looking at, this episode will be a bigger downturn than what we saw in the GFC. Pretty close to it now. As we see further falls over the next few months, we'll actually surpass the GFC. So yeah, it's quite a sharp downturn. And as I say, interesting psychology, because even though it's been so sharp and so significant, sort of people have just got used to it. It's a strange mindset thing. So a bit of in that subheading there, a few numbers around the country of the peak to trough decline. Wellington's down 16% on our index, so really quite a bit of weakness around the wider Wellington area. A lot of weakness in Lower Hutt, Upper Hutt. That market's been quite soft. The Wellington city itself not as weak, but still down, and Porirua down as well. So that wider Wellington area has been pretty soft. Auckland and Dunedin minus 10%, so falls there as well. Tauranga 9%, and even you can look at Christchurch there, only down 4%, and that's less than the national average, but it's still a 4% decline. I think there's more to come. So even though there's always different relativities across the country, the key message is that all markets are pretty soft. Left-hand chart here is just the national average property value and the quarterly and annual change. You can see the annual change there, that light purple line is now turned negative. So prices now are lower than they were a year ago. So we're certainly into full-on downturn mode now. And the quarterly change there, in darker blue, has been negative for a few months and is actually now falling at a faster pace than what we saw in the GFC. So just that wider context that this is, it's already about on a par with the GFC. And we've got more to come. Average property values around the main centres on the right-hand side, and you can see here, this is just the level of prices. You can see here the pretty sharp downturn in Wellington, that purple line, but Auckland, Tauranga, all of the markets are pretty much down. Christchurch is in red there, but a bit harder to detect. As I said, it's only down 4% from the peak, but it's still seeing some falls, and there's more to come. So yeah, pretty widespread downturn, both in terms of sales and in terms of prices. Now, hopefully these show up all right on screen. These are our getting down to suburb level here around Auckland and Wellington as examples. So what we've got here is each suburb in these cities. The size of the circle is the number of properties, and the shading is the degree to which median property values have changed in the past 6 months. So anything that's red or orange, sort of that colour, has seen falls. Anything that's grey is flat, and anything that's sort of, aqua, blue-green, has seen rises. So, look at the maps. You're not seeing any aqua, blue-green on there. It's widespread falls. A lot of red, certainly in Wellington, as I said, upper Hutt, lower Hutt. There's certainly been a lot of weakness up there. So a lot of suburbs falling pretty significantly over the past 6 months in those markets. But Wellington City had some falls as well, and up Porirua too. So pretty widespread falls around Wellington. Similar message in Auckland. If you switch to the left-hand chart there, some markets have held up a little better than others, or some suburbs have held up a little bit better than others. Those ones that have got a sort of lighter pink shading. But again, you cast your eye over that map, and it's really widespread falls. So I think another characteristic of this downturn is that it's not. Look at the North Shore there, expensive market, it's seen falls. Look to the south, cheaper market, not cheap by any means, but cheaper, it's seen falls, right across the city. So I don't think there's any sense here in which this is a sort of upper end or lower end or different property types downturn. There's not really any distinctions there. That's pretty much across the board. Doesn't matter sort of if you're an expensive suburb or cheap suburb or what type of property it is. We've seen the downturn hit all types. Yeah, and these have been that more general sense in which Auckland and Wellington have been some of the weaker markets when you look at the aggregated level. So, interesting insight there at the suburb level, pretty broad based, and doesn't matter property type or location. Listings. So, a big part of this downturn or the slowdown in the market, certainly in terms of sales activity, has sort of fed into listings, and there's now more listings on the market, so buyers have more choice. They don't have to rush. That puts pricing power in their court, and of course we're still seeing property values fall. So a little bit around listings. As I've got on the top heading here, new listings, certainly into their spring surge. So new listings coming onto the market always rise this time of year, so we're certainly into that period now. And so what that's doing is new listings are rising, sales activity at the other end of the pipeline is still really weak. So of course what you get in the middle is stock on the market rising. So you're replenishing that stock. It's not leaving it at the other end through sales, so the choice for buyers is rising. So the chart on the left illustrates that at the national level. The pinky line there is 2022. You can see that that's starting to tick up. We're into that spring rise, and so total stock on the market is ticking up. Now also, total stock on the market at this point of the year is higher than it was in 2021. That's the purple line, significantly higher. And now it's also higher than where it was in 2020 as well. So at that national level, we've got more listings on the market now than we've had for at least 2-3 years. So there's more choice for buyers, and that's contributing to the weaker prices. Just an interesting contrast, though, if you switch to the right-hand side between Auckland and the national picture, look at the Auckland 2022 line is actually below 2020. So, things aren't, they're still loosening in Auckland, but they're perhaps not as loose as what you might have at the national level. So an interesting, a little bit of a contrast there. Buyers in Auckland have more choice for sure. They've got more choice than they had this time last year. That pink line's higher than 2021. But it's lower than 2020. So buyers have more choice, but it's not all one-way traffic. Sellers still have some pricing power as well. So an interesting contrast there. And actually, that pink line 2022 for Auckland is over the course of the year, from about March, April, has actually just been drifting lower. So that stock has been absorbed a little bit. Now it's not stopping prices from falling by any means, but just a little bit of balance in Auckland. Buyers don't have it all their own way. All right, what about buyer classification? So this is our flagship data series for us, looking at every transaction in the market and who was on the buying side of that deal. Now, these are market share numbers, so this is share of purchases as opposed to the number of purchases. But what are we seeing? First-time buyers holding on. That's probably the best way to put it. So the chart on the left here is by classification at the national level. first home buyers in red. So you can see, if you sort of squint a little bit, you can see they've just had a slight uptick in their market share lately. First home buyers up to 23%. Go back to the start of the year and they're running about 20% of activity. So first home buyers are holding on. They're just slightly increasing their market share. You've got to acknowledge that the number of deals going to first home buyers is still low. Number of deals going to all buyers is low. Just that first home buyers are holding on a bit better than other groups, and so their market share is rising. So, first home buyers are still a reasonable presence in percentage terms, so that's encouraging, as opposed to mortgaged investors. So mortgaged investors or mortgaged multiple property owners, and that sort of purple line there, down at 21% lately. So if you sort of trace back through that line, go back 12 or 18 months, prior to the LVR changes, prior to the interest deductibility changes, when interest rates were still low, mortgaged investors actually accounted for pushing 30% of activity. So there's that really high peak for that purple line there. Then all the changes have come in, yields are still low, rents are slow, and a lot of challenges building up for landlords, and so they're not purchasing. 21% going to mortgaged NPOs is, if you trace back through there, is the lowest on record. So actually the presence, in relative terms at least, of mortgaged investors in the market in the last sort of 6 to 9 months is pretty much as low as it's been. So hard to get those sums to work for mortgaged investors, hard to make those purchasing sums work. And so they're taking a step back from the market. So that's probably helping first home buyers as well, a bit less competition from investors. And then cash MPOs, 15%. So this is quite an interesting one. That's the cash investors, people who don't have to rely on the bank. They're not worried about mortgage rates, they're not worried about credit criteria. So actually enjoying a pretty good market share, 15%. So people with cash, stands to reason in this market, people with cash would be doing okay and perhaps seeing some opportunities. So interesting contrast between cash and mortgaged. Should just say around mortgaged investors, their purchasing activity is low for sure, so they're not making many purchases. But we're also not seeing any evidence that people with existing landlords, existing investors, people who purchased a while ago and now own that property, are not selling. So yes, we're not seeing much purchasing activity, but we're also not seeing much selling activity. So people who already own property, already own investment property, are staying in the market. They're probably doing okay. They've made some capital gain. They're happy to hold on to that property, just that new buyers aren't purchasing. So quick switch to Auckland on the right-hand side. Pretty similar patterns. Cash MPOs or cash investors are up in Auckland, 13%. And first-home buyers are still hanging on, 26% as well there. So first-home buyers doing pretty well in Auckland. I think the slight difference between Auckland and the national level is the mortgaged NPOs, or mortgaged investors. That purple line there is kind of hidden underneath the first-home buyers, but they're at 26% as well. So actually, nationally, mortgaged investors are struggling a little bit, but within Auckland, those mortgage buyers are actually still doing okay. So investors still have a reasonable presence in Auckland. They're making the sums work and actually still got a higher presence than they do at the national level. So it's an interesting pattern within Auckland. Investors still able to make those sums work. Okay, as I said, lots of challenges for landlords and they're not purchasing as many properties as they used to. I've touched on some of those challenges. Just to add to those headwinds, as they call them now for landlords, rental growth is slowing. So that's just an extra challenge that landlords are going to have to deal with. Might mean that their purchasing activity stays pretty low. So just to illustrate that, on the left-hand side here, we've got rents from Stats New Zealand, the index, the level of rents, an index level of rents at least, in purple there. And you can see that that's really stopped growing in the past 6 to 9 months. That purple line has really tailed off. And you can see that in the growth rate. So the annual percentage change in blue there has really dipped off. Go back 6 to 9 months, go back to the start of the year, rental growth was running at 6, 7, 8% on an annual basis. It's now down at sort of almost pretty much 0% or 1%. And in fact, the prior month, it actually turned negative. So we actually saw rents for a brief period actually lower than they were a year ago. So yeah, the slowdown has really come through quickly for the rental market. We're seeing that extra challenge for landlords. Now, why is that the case? Well, it could be any number of reasons, but a key thing is it seems that, so we've currently got this net migration outflow, which you can see on the right-hand side here, where we're losing people in net terms instead in terms of migration. And there'll be a tendency for these net migration outflows of people leaving the country to probably be younger, to probably be renters. So it's taking out some demand from that rental sector. So less demand, you tend to see rents slow down, and just recently we actually had them slightly fall. So there does seem to be this correlation at the moment between slowing rental growth and negative net migration. So just the key point here is just another challenge for landlords.